Hey everybody, Marty Missouri, good morning. July 23rd, 2018, Monday. Thought I'd share with you some work I did over the weekend. I mentioned in this morning's weekly message that the action so far in 2018 looks to me more like a consolidation in an ongoing bull market than it does the sawtooth look that you tend to get prior to looming bear markets. So here we have 2017, which, as we now know, was a good year with the S&P up about 19% last year. And here we are so far in 2018, just a little bit higher than the beginning of the year by about 4%, closer to even for the Dow, a little underwater for the NYSE composite, which would be your broadest based average of the three, and then foreign stocks still down notably so far this year. But as for the S&P 500, which is arguably the most watched average, which is why we use it here, not necessarily the best benchmark, but since it's so widely viewed among professionals and consumers, we use it in these charts. So anyway, so here's the look currently. So what I'd like to share with you this morning is a comparison of the look so far in 2018 versus the other years over the past 20 or so that have been the kinds of years in terms of return that we just experienced in 2017, 1995, 2003, 2009, and 2013. For each period, this is right where we are today. So now let's take a look at them individually and really focus in so we can do more justice with the chart. So here's that 34% in 1995 for the calendar year. And here's what we look like right now at this point in 1996, July 23rd. The question now being, did we ultimately break out of what we call this consolidation box to the upside or to the downside after such a strong 1995? The answer is substantially to the upside. 4 years later, the S&P 500 saw another 186% gain to tack on to the 34% experienced in 1995. And you can imagine at this point in 1996, which looks very similar to where we are right now, folks were probably beginning to wonder, beginning to get a little discouraged and so on. But if they stayed the course, they did obviously exceedingly well going forward. So how about the 2003-2004 period? So here we are with a nice 22% gain, just a little better than last year. Here we are at this point in 2004, negative like we are today with the NYSE, but this is the S&P 500. How did the market do 2004 forward for the next 3 years? Well, quite good. You can see that the market tacked on, or the S&P 500 tacked on another 39% over the next 3-year period. Not as stellar, of course, as that 96 beyond period, but certainly worth hanging in there with its attendant volatility along the way. So how about the 2009-2010 market? Of course, 2009 was the first year after the Great Recession bottomed, and you can see the first 3 months was a continuation of that bear market. It bottomed, I believe it was March 9th, 2009, and for the year, we ended up with a very nice 22% return once again. 2010, a little bit off at this juncture. How about going forward? Well, it was another 77% for the next 3 years. So again, 2009, good year. 2010, like 2018 so far, consolidating. Ultimately broke out of that box, and you can see it was a very nice return. So the combined 4-year period return there was almost 100%. And lastly, 2013, 2014 had a great year in 2013 with the S&P up 26%. 2014 did continue to do well up to late July. However, as we experienced, the consolidation ended up lasting a great deal longer. In fact, we really didn't break out to the upside until well into 2016. But when we did, as we've noted in 2017, we've had a very nice return and a very profitable 57% gain for the period of late July 2014 up until the end of 2017. So my point here, folks, it is very common, certainly in each of these 4 instances where we had years comparable or better than what we've experienced in 2017, to have a period of sideways motion before we ultimately break out to the upside. Now, could we indeed break out to the downside? Well, of course we could. So let me show you our chart where we've done some back testing of our macro index. And I think I could certainly draw some boxes here. I could see a nice run up here and draw a nice box here. And maybe I could use history to suggest that odds favor a breakout to the upside. But indeed, the market did not break to the upside. It broke decisively to the downside. And we had a really tough bear market that was really characterized by the bursting of the tech bubble. Here we are in late 2007, could have easily drawn one of those boxes around this period right here and suggested that we were going to break to the upside, but we didn't. We broke to the downside during the worst recession since the Great Depression. And if we look back to the illustrations I just showed you, here we are coming out of that break to the upside, and here we are in 1999, as I showed you. Notice the green numbers here. That's our PWA macro index score. When they're green, they suggest that odds favor continued expansion, not recession going forward. Here we are in that 2003 period. We had that nice year. Here's 2004 consolidating, and then we broke out to the upside, as I showed you. But look at the macro score. It was a 48. Here we are, 2009. Here's that 2010 sideways move. Here we are breaking out to the upside, but of course we were green on the PWA index. Here's 2013. Here's that consolidation, 2014. Here we are today, consolidating again with a PWA index score as of this morning of 48. You can see that is really what looks very different compared to these periods where what looked like consolidation ultimately broke to the downside. And we had really tough bear markets. It happened here and it happened here. Today, obviously, when you look at macro conditions and as well as a chart, this period today looks more like these periods here. So this is something that we do on an ongoing basis. So this is the kind of analyses that we will do over and over and over again. And as we've stressed ad nauseum here on the blog and in client reviews, the decisions we make in terms of our sector weighting has to do entirely with our assessment of general conditions as we sit here today. As those general conditions change, as things begin to turn negative, which they ultimately will, then of course we have an entirely different conversation about the positions, the sector weightings, asset class weightings we adopt within client portfolios. Folks, thank you as always for watching and listening, and we'll be back soon. Take care. Bye-bye.